Hey everyone, and welcome back to the Tesla Stock Podcast. It's been a wild ride for Tesla this year, with the stock climbing over 60% in the last 6 months, capped off by a record-breaking delivery number in the third quarter. But just as the bulls are feeling emboldened, the company's new affordable cars have landed with a thud, and a closer look reveals they might not be the silver bullet Tesla needs. With the stock now trading around the $449 mark, we need to break down the bull case, the bear case, and the reality of the company's new product strategy. Let's start by looking at the bull case, which is feeling stronger than it has in a long time. The company's recent record-breaking Q3 delivery number of 497,000 vehicles handily beat Wall Street expectations and showed that demand, at least in the short term, is still incredibly strong. This has been followed by the official launch of the new, lower-priced standard versions of the Model Y and Model 3. Top investor Daniel Sparks argues that these cheaper models are a clear positive for two main reasons. First, they expand Tesla's addressable market by offering a lower price point, which is crucial now that the $7,500 federal tax credit is gone. And second, and perhaps more importantly, for the long-term story. Every one of these new cars comes with the hardware necessary for the future Robotaxi network, accelerating the growth of that potential fleet. He sees this as a key step in bolstering the company's software monetization opportunity. However, the bull case isn't just about the present. It's about a future that many believe is already being priced into the stock. The company's valuation is once again in the stratosphere, which suggests that the market is already factoring in a massive amount of future growth from these long-term bets like the Robotaxi network. The challenge for investors now is to decide whether the recent good news is a sign of a sustainable turnaround or just a temporary bump on a very long and uncertain road. But while the bulls are celebrating, the bears are pointing to the fine print. And our second story takes a closer look at the actual value proposition of these new affordable models. Just 3 days after launching in the US, Tesla has now released the new Model Y standard in Europe, and the details reveal a fascinating and very different strategy for that struggling market. While the US version was widely panned for its small price cut relative to the large number of missing features, the European version is a much better deal. The price cut there is more like 20% or about $10,000 compared to the premium trim. And even more importantly, the European version is missing fewer features. Two of the most controversial removals in the US version were the lack of power folding side mirrors and, most shockingly, the removal of auto steer, the basic lane centering feature. The European version actually keeps both of these features. So, for a much larger discount, European buyers get to keep two key features that their American counterparts have lost. This is a clear signal of just how desperate Tesla is to stimulate demand in Europe, where its sales have been tanking. It's an aggressive move to fight back against the competition, and it's a much more compelling offer than what's being presented to US buyers. And that brings us to the core of the problem for Tesla, and our final story. The reason sales have been tanking in Europe, and the reason the company is having to make such aggressive moves, is a perfect storm of political backlash and a lack of product innovation. As one recent analysis put it, it's not just Elon Musk's distastefulness that is harming Tesla, but also his poor leadership on product innovation. The company has only released one truly new model in the last 5 years, the Cybertruck, and that's not even available in Europe. While the Model 3 and Y have received significant refreshes, the lineup has started to look stale, especially when compared to the flood of new, high-tech, and low-cost models from Chinese and European competitors. This new Model Y standard is a direct response to this problem. But it's a defensive move, not an offensive one. It's a stopgap measure to try and hold on to market share. The real innovation and the truly affordable ground-up $25,000 car that was promised for years has been canceled. And as the same analysis points out, that innovation may not be coming anytime soon, as the CEO seems to have all his focus on the company's future in humanoid robots and AI, rather than the core car business that is responsible for virtually all of its revenue today. This is the central conflict for investors. Can a company thrive when its leader's attention seems to be so far removed from the business that is under attack right now? So, to sum it all up, the bull case for Tesla is strong, fueled by record deliveries and the launch of new, cheaper models that will grow the potential robotaxi fleet. However, a closer look at these new models reveals a much better deal is being offered in Europe, a clear sign of the company's desperation to fight back in a market where its sales have been collapsing. And the root of that collapse is a combination of political backlash and a lack of new, innovative products, a problem that this new, stripped-down Model Y is a temporary fix for, not a long-term solution. This brings me to my question for you. What do you make of the different strategies for the new standard models in the US and Europe? Do you think it's smart for Tesla to offer a much better deal in the market where it's struggling the most? And more broadly, do you think this new stripped-down Model Y is a compelling enough product to reverse the company's sales slump and fight off the intense competition? Or is it too little, too late? Let me know your thoughts in the comments below. As always, if you found this breakdown valuable, please hit that like button, subscribe to the Tesla Stock Podcast, and be sure to turn on notifications so you never miss an update. Thanks for listening, and we'll see you next time.